Okay, hi everyone. Let's take a look at problem 1-7A, which asks us to analyze transactions and prepare financial statements. Now I'm reading just to the left of my mouse here. Holden Graham started the Graham Company, a new business that began operations on May 1st. Graham Company completed the following transactions during that first month, and we'll go over these in a minute, but let's look at the requirements. All right, what we need to do is arrange the following assets, liabilities, and equity in a table and with the following columns: cash, accounts receivable, office equipment. You see I'm just reading right here, okay? Dividends, revenues, and whatnot. And then we'll show the effects of those transactions on the accounts using a minus and then showing the dollar amount as well. Okay, so what I'll do is I'll work this on the next screen as we look at the transactions. So let's slide back up. Okay, so the first one, on May 1st, to the left of my mouse, H. Graham, the owner, invested $43,500 cash in the business in exchange for common stock. Alright, so now I've set up the accounts so that you can see it on the screen. Now I know it runs off to the right, but I'll move that a little bit as we have to. But here it says dividends plus revenues, and there's one other column that says expenses. Alright, so we've got an investment in the first one, so we know we have some kind of increase on the equity side, and we also have an increase in the cash of that dollar amount provided. So if I slide down, what we see is the dollar amount was $43,500. We enter it as positive numbers to both cash and to common stock. All right, now I'm going to turn the cursor off, the highlight cursor off, because I think from here on out it will just detract from what we're trying to show. Let me turn that off. Yep, now it's off. And we'll read the second part. Rented a furnished office and paid $2,100 cash for May's rent. You know what? I actually will use it on occasion. So right here, rented a furnished office, paid $2,100 cash for May's rent. So if we jump back over here, then what we know is we use $2,100 in cash, right? So we use that and we paid for a rent, and that's an expense. Now let me slide this over so you can see it. Okay, and there's our $2,100. Alright, now I know this is going to be a little bit hard. Actually, let me see if maybe I can shrink the screen. It's going to look a little fuzzy, but I think that'll work. I think that'll work pretty nice. Okay, number 3. Purchased a $1,920 of office equipment on credit. Well, office equipment is an asset. So if we purchased it on credit, that means we owe somebody a liability. Liabilities should have gone up. We see the 1920 as a positive showing up under liabilities. Okay, and then we see the increase in office equipment of 1920 showing up as well. Okay, on the 5th we paid $780 cash for cleaning services. We jump back over here. We should see cash go down by $780, and then expenses go up by $780. So we're still in balance. Remember that assets equals liabilities plus equity. Okay, on the 8th, provided consulting services for a client, immediately collected $5,600 in cash. So now I want to see revenues go up, because that's what we do, of $5,600, and the cash goes up of $5,600 as well. Okay, on the 12th, we provided $2,900 of consulting services for a client on credit. Now what that means is they didn't pay us up front, so we expect to receive that in the future. That means we've got a $2,900 debit to accounts receivable, but we still record the revenue because we record revenue when it's earned, and after we've completed the consulting services, we need to record it. Alright, 22 says $3,100 of consulting services on credit. So now we've got the exact same entry again. Oh wait, did I go to the wrong one? We're on the 15th. Yeah, 15th we paid $740 cash for an assistant's salary for the first half of the month. And I'm assuming we're going to ignore our tax obligations on that. And so cash decreases by $740, and we record some kind of expense for those salaries, either salaries or wages expense. And we'll ignore taxes for now. Okay, then we receive the $2,900 cash for the services paid on May 12th. So now all we're going to have is a crisscross between the accounts receivable and cash. And see how that works? The accounts receivable is reduced because they just paid it. So essentially all we're doing is replacing one asset, accounts receivable, with another, cash. Next transaction is the 22nd. We provided $3,100 of consulting services on credit. Okay, $3,100 of consulting services, debit to accounts receivable, and we show the revenue is $3,100 as well. Now the 25th, we received $3,100 cash for payments of the services on the 22nd. So what we see is the accounts receivable going down and cash going up by that same amount. All right, 26th, we paid $1,920 for cash for the office equipment on May 3rd. All right, well, the office equipment on May 3rd we purchased as a liability, so now we want to reduce that liability and also reduce cash. And again, the debits equal the credits, or a better way to say that at this point in our knowledge is that the accounting equation is in balance because we reduced cash by $1,920. We also reduced liabilities. So the next transaction is the 27th. We purchased $90 of advertising in this month's local paper on credit, and the cash payment is due on June 1st. So we have an expense of $90 for advertising, and we have an obligation that increases, and we show that in accounts payable because we have to pay that at some point in the future. On the 28th, we pay $810 cash for the assistant's salary. So let's show that. Cash should decrease by $810. We have that assistant's salary again showing up under salary expense, so we show it under the expense column. Now we move on to the 30th. We paid $300 cash for this month's telephone bill. $300 credit, and $300 increase in expense. Then we paid $280 cash for the utilities. So there's our $280 cash going out, and the utility bill being recorded. And then on the 31st, we pay $1,900 for cash for dividends. All right, so cash goes down by $1,900, and we show dividends, which is actually a subtraction, but because its equity is common stock minus dividends plus revenues minus expenses, we show it as a positive number. And we're still in balance because that's a negative, and we have a negative number on top, right? So that because it's a minus signs in front of that, we're still in balance. And that takes care of the first part of this problem, everyone.